the issue of trust in part 3 of this roundtable discussion, and in particular, whether different or new types of life insurance products can contribute towards delivering greater certainty, and in doing so, help to rebuild trust and consumer confidence in the value of life insurance in Australia.
So we come to the issue of trust, and I use that as a segue to talk about product. And it's fantastic to welcome Ilan Leese to the conversation. You've been sitting quietly listening to your peers have a conversation about the life insurance sector, present pain points and looking at the future. And products raised its head as a topic in a few of the conversations so far, Ilan. I'd very much welcome your views with regard to what the future might look like with regard to product, what the current pain points might be. But I'll set the context for what Ilan's about to say by reading one of Ilan's own, some of Ilan's own words from a paper he wrote recently. It's about trust. Ilan says, "Trust is keeping a promise, which means that every person purchasing insurance needs to have full confidence in the outcome, not relying on fate, nor probability, nor an outcome that they could never imagine." That's the trust equation when it comes to buying life insurance. If we use that as a broader context, and if I can hand it over to you, Ilan, to have a conversation about how you see the future while still acknowledging the existing pain points when it comes to product, over to you.
Okay, so if I can I just comment on, try to listen to a lot of things. There's a lot of conversation there, right? Probably the starting point for me is actually going back to the context of the industry we're sort of in at the moment. And David, the recent APRA results, which I think came out on Thursday, if you go the next layer down, you look at them, you actually see the disability income made, $1.1 billion profit. So this is now a year earlier was minus 350 million loss. So it says a bunch of things to me, and some of them you've sort of alluded to, Danny, at the last comment you made. One is some of these benefits might be unpriceable. So there are things going on with trends that I sort of wonder, until those trends are stabilised, mental health might be an example, do the buyers of these products really understand the risks? And that goes back to the advisors must be selling these things and then find out actually, oh my God, I didn't realise that the price could go up, right? So that's sort of one question. I get very nervous listening to the industry. I'm going to be careful what I say. Maybe this gets edited out, I'm not sure. But I get nervous whenever everyone talks about sustainability, because I think it's being used at the moment as an excuse or justification to put rates up, potentially recoup. And when you see things like the profitability swings like they're happening at the moment, there's more in there. So I'm oversimplifying why it's $1 billion, by the way. So there's interest rates going up actually changes the reserving, which gets this massive release of profit. So it's not as simple as they just put rates up and suddenly they make profits. There's a whole bunch of reserving things going on there. But that said, it's doing this, right? So when everyone's using the word sustainability, I think it's sort of being, it's probably a question of who do they mean sustainability for who? Is it for customers or is it for insurance companies? And I suspect it's actually the latter, using it as a reason to, say, well, therefore we put rates up. Which a good example is like level premiums. That I've got a level premium policy. I've had 80% increases, and it's I've written about it in one of our papers. We've been tracking one policy. The title of that section is N equals 1. It tracks my policy. It's going up and up and up. And I think on the level premium stuff, in a way, I kind of wonder if the industry has considered the it's almost like that trust license that they've almost broken with advisors. But the minute they started putting those up, it's a short-term win. But in the long run, I wonder how many advisors would trust putting their clients into level, because it could go up, and it's a bit of a trap, because once you go in now, in a few years' time, you can't, a level policy at the same age or even a step policy at that age is so much higher. Insurers can just lift the price just below.
Okay, then. So there is that trust issue. What do you do about it?
I don't think the solution is in product. That's probably important. I think the solution is going to come through distribution. I think the product is an enabler of what should be happening when you're helping clients. One of the things we put into that paper was this idea that if you started again, what would you build? And maybe the original purpose of life insurance, if you go back hundreds of years when you had mortality cover, was, to pay for an event, to pay for, it's an objective event, someone's died, and you pay because they've lost money. There's a financial implication, right? And when you fast forward to today, we've got a lot of benefits where there's a subjective decision on whether you get paid, and it's not always linked to the actual financial loss. So one of the concepts we put forward in that paper was, almost starting with those two principles, and said, well, what would you build if the only insurance you sold had an objective outcome and it was linked to the actual financial loss? You'd build something fundamentally different. You'd probably get rid of TPD, you'd probably get rid of even RP in its current form. You'd start with death, you'd end up with something that looks like a little bit like trauma, and without going into the detail of the product concept, because that's not relevant, you would just go in a different direction, right? And where we were coming at, actually, interestingly, why we wrote that paper was because we were seeing so many claims being declined for the subjective type products. So, 1 in 8 or 1 in 9 claims are being declined for TPD and trauma, right? So that's not it's another trust issue that needs to be solved.
How far down the track are you then, Ilan? The basics here, I'm just reading from previous notes. A claim must be able to be objectively measured. An actual financial loss must have occurred. You're rolling to an extent into health insurance type narratives, but how far down the track are you in terms of designing a product that could be marketed to the Australian consumer along those lines?
So I think that paper was trying to push the boundaries a little bit of what's the extreme, not what I think is practically going to happen in the next 5 or 10 years. One of the reasons, I suppose one of the challenges that we've struggled with, and this is interesting to hear the advisors around the table, it's not a product issue because, and so I'm talking about why it's a distribution question, because you can design a better product, I think. But if you build this thing and no one sells it, what's the point? And that's been done over and over and over. You talk about, the Macquarie severity-based product. It is innovative, it is different, but doesn't get sold. And I think this market's different to South Africa. You keep, I think different markets try and borrow and say, what works there must work here. South Africa is a product-led market, very different. I think here, if you're selling these products and it's different to everyone else's, I wonder how much fear as an advisor you have, selling something completely different, because the risks are now new that, I would have been able to claim over here, but I can't claim over here. Who's got that risk? And I'd be interested in hearing views on if you could build the product and advisors said, look, we'll move everyone into that and we'll be safe to do that because it's best interest, you do it. And I think there's some disconnect at the moment with, even on the recent IDR product, same problem.
Well, thank you very much for that reflection, Ilan. I guess it's given us all a lot of food for thought. But from the advisor perspective, I was wondering, Adam, if you had any thoughts on what Ilan's just reflected on.
I think it's an interesting concept, definitely. And the principle of indemnity versus just a certain amount of cover for a specified event. When I think about advisors at the moment, my sense is in terms of distribution, we provide advice, and it's really that is what will cause a greater consumer engagement. And at the moment, I dare say Danny's seeing this at present. There is a bit of a crisis with advisors in terms of confidence, and that's off the back of just one change after another. And I think too, there's been a focus in financial services historically, maybe more so on the wealth side, and in recent years there really hasn't been, maybe particularly when you look at the licensees, their focus has been more on wealth than it has been on insurance. So I'm getting feedback from advisors at the moment, particularly around, let's say, income protection and the changes that have occurred there. Because we've gone from an environment where there's been own occupation definition and certainty there, now there's a range of definitions in the marketplace. A lot of advisors that don't have specialisation and expertise, as I think Danny was saying it's all too hard. So I guess this is as much a question as an answer. What are the things that we need to do as a profession at this point in time to equip advisors with the confidence to provide insurance advice, because it is an obligation under best interest. And I think, I said earlier, today more than ever, people need insurance advice. They've got the same needs, but we do have this situation where a lot of advisors say, it's too hard, it's too complicated, I don't properly understand it.
Okay, I'm turning to Mark and then Catherine about your take on the product reflections.
Yeah, something about the distribution rather than product. I'm still, from an advisor point, I want to have certainty on product. I really want to. I get the indemnity model, but if that causes problems in general insurance, still, floods, am I actually going to get this? I'm not going to get this, or I'm only going to get a percentage. Whereas a certainty of a product and the amount of insurance, I've got 500,000. I know I'm going to get 500,000. That's far easier from an advisor's point of view to help solve a need for a client, and so I still want to look at the product. I get the distribution is important, but indemnity type, so I'm still struggling with that. From an advisor, I need certainty of what I'm going to do.
Thank you. What about you?
It's similar to Mark in terms of certainty is something that myself and clients understand. If you look at, for example, the Macquarie Active product that came out, a lot of advisors struggled with that. And even those that did, they had that background of being risk-based. Then having their clients understand that was more of a challenge. And I think the biggest risk for our clients is not meeting between advisors and getting into trouble with your clients is not delivering on what the clients are expecting. So I think that's a risk that a lot of advisors don't want to touch. In terms of the comments around, say, stepped versus level premiums, I think it's interesting to look at the level premiums have been subject to such steep price increases, which I'm going to say I found really disappointing for a number of reasons. Is Australia is fairly unique in the world in that we have such a heavy focus on the stepped model. Around the world it works quite well. So what is it that we have done incorrectly as a market with level premiums rather than does it not work as a concept?
There's a big, I've worked in a few markets or countries, and the major difference is guarantees.
Okay.
So it's interesting just to reflect on that. So
we've just removed some of the guaranteed elements.
Well, this market's not had proper guarantees at all. Like the UK, you'd have a 30-year guarantee of level premiums, and you knew for 30 years.
BDM guaranteed, no?
Which is an entire round table in itself potentially.
Yeah.
So, in the interest of time, unfortunately, we have to move on and get your take, Amanda, on what you've heard so far before we move to Ruth.
Oh, very brief. The new innovative products, I think everybody's going to have a take on them, and whether they will understand or want the indemnity versus the traditional ones they know and love. I think when new things come out, it is harder to go, do I want to go down that path or will I stick to what I know and love? So you've got that bias against, but I get this and I'm familiar with it. So it may be the best thing ever to throw away the rule book, start again, write something different. But will the uptake from advisors be, I'm really excited about this, or it's a bit too new and woo-woo for me and I'll stick with what I know. Exactly. Yeah.
In the fourth and final part of this Risk Info Roundtable series, our panellists share their own perspectives for the future of the life insurance advice sector in Australia.